Something very strange just happened with NIO stock. The company just reported one of its strongest earnings reports in years. Revenue surged higher, deliveries nearly doubled year over year, margins improved massively, losses narrowed far more than Wall Street expected, and management gave aggressive second quarter guidance that immediately got investors talking about a possible breakout phase for the stock. So why did NIO still dip after earnings? That is the real story right now, because what we are seeing with NIO is not weak fundamentals anymore. It is a battle between improving business performance and a market that still does not fully trust Chinese EV stocks after years of volatility, dilution fears, and failed rallies. And honestly, this might be one of the most important turning points NIO has faced in a very long time. If you want the real breakdown without fake hype, subscribe with one quick tap because this EV sector is moving incredibly fast right now. NIO just reported first quarter 2026 earnings, and the numbers came in stronger than many investors expected. Revenue reached roughly $3.8 billion, beating expectations near $3.7 billion. The company delivered over 83,000 vehicles during the quarter, representing around 98% year-over-year growth. But the biggest surprise may have been guidance. Management said second quarter deliveries could reach between 110,000 and 115,000 vehicles. That immediately became one of the biggest talking points across the EV market today. And here is why this matters so much. Investors were worried that China's EV slowdown and brutal competition were destroying profitability across the industry. Price wars have pressured nearly every major EV company. Many investors started questioning whether companies like NIO could continue scaling without burning cash forever. But this earnings report changed the conversation. Vehicle margins improved sharply to roughly 18.8% compared to just over 10% a year ago. Gross margin climbed close to 19%, while adjusted profitability actually turned positive during the quarter. That is a major shift because for years, the biggest criticism against NIO was simple. The company could grow deliveries, but it could not prove that growth would eventually become financially sustainable. Now suddenly, that bear case is getting weaker, and honestly, the market knows it. But this is where things get fascinating. Even after these strong numbers, the stock reaction stayed mixed. Why? Because investors are still stuck between two realities. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. It's the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. The first reality is the operational story. Revenue is surging, deliveries are accelerating, margins are expanding, guidance is strong. NIO appears to be entering one of its strongest scaling phases in years. But the second reality is psychological. Investors still remember years of disappointment across Chinese EV stocks. They remember dilution fears, price wars, collapsing rallies, and heavy volatility. So even when strong numbers arrive, the market hesitates before fully trusting the recovery story again. And that hesitation may actually be the biggest opportunity here. Because if NIO continues executing at this level over the next few quarters, the market may eventually be forced to completely rethink the company's valuation. Management clearly believes momentum is accelerating. CEO William Bin Li said the company has entered an intensive new product launch and delivery cycle. That is important because it signals confidence that this growth acceleration is not temporary. NIO recently launched new vehicles while continuing to expand its broader ecosystem strategy through multiple brands and battery swap infrastructures. And battery swapping may quietly be becoming one of NIO's biggest long-term advantages. While most EV companies compete mainly on charging speed, NIO continues building an entirely different ecosystem focused on convenience. A system designed to make EV ownership feel closer to refueling instead of waiting around to charge. For years, Critics argued that the infrastructure costs were too expensive, but now that margins are improving, investors are starting to look at battery swapping differently. Some analysts now believe it could become one of the reasons customers stay locked into the NIO ecosystem long term. Still, there are real risks here. Competition inside China's EV market remains brutal. Tesla is aggressive, BYD keeps expanding globally, Xiaomi surprised the market with strong EV momentum, XPeng and Li Auto are still highly competitive. That means NIO still has very little room for execution mistakes. If delivery momentum slows or margins weaken again, sentiment could turn negative very quickly. And honestly, that is one reason the stock did not explode higher after earnings despite the strong report. The market wants proof that this improvement is sustainable, not just one strong quarter. But if NIO actually delivers what management is now guiding toward, the setup could change dramatically over the next several months. Think about what the second quarter guidance implies. Management is targeting up to 115,000 deliveries in a single quarter. That would mean monthly deliveries consistently above 35,000 vehicles moving forward. That is not small-scale growth anymore. That starts pushing NIO into a completely different operational category. And if the company combines that level of scaling with improving profitability, the stock may finally have the ingredients needed to break out of the long consolidation phase that trapped it for years. This is why investors are watching the next few months so closely. Not because one earnings report solves everything, but because this report may have confirmed something much bigger. The turnaround story might actually be real. And if that is true, the market may not have fully priced it in yet. Because operationally, NIO just delivered one of its strongest quarters in years. Revenue surged, margins improved massively, losses narrowed sharply, delivery growth exploded higher, guidance came in aggressively strong, and yet the stock still trades like investors are waiting for another disappointment. That disconnect is exactly why the next few months could become extremely important for NIO stock. Because if execution continues at this pace, today's earnings report may eventually be remembered as the moment the entire narrative around NIO finally started changing. This is it for this video, guys. Thanks for watching and please make sure to subscribe, like and leave a comment down below.